And good morning, everyone. I am Randy Price, and we are the Price Group here in still 100-degree Houston. And welcome to our continuing efforts at communication and education, as we've done for several years, what we call our halftime update. We've worked on a special title, Are We There Yet? And we thought that really fit what we're going to be talking about today. As far as where we've been and also where we are going. Who are we? Those of you that have been around for a while know that we're a family owned and operated firm that specializes in retirement planning. We're very passionate about being fiduciary centric in everything that we do. And would also be remiss without mentioning that Matt's recent promotion to managing director, and also Maddie Kearns in our group was just recently promoted to vice president. So anyway, we're thrilled with that. We're thrilled that you are here, and let's get into some of the topics of discussion for today. Matthew.
And it looks like we have a few dozen clients on the phone. This will be a familiar page, but Randy and I both CFPs, certified financial planners, CIMAs, certified investment management analysts. We think education in our business is really important. Randy's been awarded Barron's, Forbes, Financial Times with so many awards I can't really keep track of them anymore. But yeah, humbled by that. A little bit just to review about our firm, Steward Partners, based off the biblical definition of stewardship. Right around 30 billion of client assets. Randy and I, we help manage approximately 700 million of that. But we think the key thing, what that means to you as a client, would be we serve as a fiduciary that Randy mentioned, and we love that we're not owned by a bank where there's someone trying to tell us, hey, you should invest client dollars this way. Raymond James is the custodian that clients use. This means that's where your investment dollars are held. We do have a few other options, but right now, all clients are comfortable with the Raymond James option.
So let's go over the agenda for this morning. And of course, we'll leave time for questions. So if you have some questions, you can let us know. And we will try to get to those at the end. Inflation and interest rates, certainly a worthy topic given what's going on in the world, the economy, financial markets, and last but certainly not least, recession expectations. And we're going to touch on one of the big issues, and that is the national debt. So let's get started. Inflation and interest rates. Here's an update on inflation, and this to me is a really interesting slide, because if you are a little bit of a geek like we need to be here, you'll know that inflation has actually pulled back. You see inflation with that blue line across the top, and really hit a high point in June of 22. All the articles coming out about the I-bonds and what they were yielding on an inflation-adjusted basis and whatever. But you'll see that inflation has, and that's good news, has come down. And we break that down: energy, food, vehicles, medical care, housing, what was pandemic impacted, etc. So inflation has come lower, and again, that's what the Federal Reserve is trying to do. Is they are a governor basically on the economy, trying to raise interest rates through their various means in order to starve the economy of a little fuel, and therefore cool it down. It's not an exact science, but again, the good news is it seems to be working. From inflation still not where where the Federal Reserve wants it to be, but lower certainly than last year, and that is good news. So here we're talking about the bond market. Remember, there's really two interest rates that we look at on a regular basis. We sort of look at short-term interest rates as measured by the federal funds rate. And then we typically look at longer-term interest rates as measured by the 10-year Treasury bond. Now, Randy, you say, when in the world would we look at the 10-year Treasury bond? Well, the 10-year Treasury bond is what basically all mortgages are based on. So if you're in the house buying or the house refinancing time period, then you're going to be paying attention to where interest rates are going. And what's really interesting is we talk to clients, there's a little technical term, forgive me, but an inverted yield curve. And what that means is that short-term interest rates are higher than long-term interest rates. The 1-year Treasury bond is about 5.4%. The 30-year Treasury bond is about 4.3%. Typically, longer-term interest rates are higher than lower interest rates. And so the Federal Reserve obviously has been on a tear to slow down the economy, to raise rates. And we started from almost zero rates. So it's been a huge move. And you can see the blue dotted line is the Fed funds rate. And the yellow line is the yield of the 10-year Treasury bond quoted on an investment basis. But anyway, what historically this higher short-term rates than long-term rates has meant is that the short-term interest rates will at some point move lower. Again, historically, the Federal Reserve, being an inexact science, has typically raised to the point which is a little too much, and the economy starts to lose jobs, so there's some pain, and then we start the cycle where the Fed would cut rates to stir the economy back. And so again, we think we're closer to the end of the Fed's tightening cycle than we are the beginning, but this has been a big move, and the bond market is indeed telling us some things about where they think interest rates are going.
So the $64,000 question for the Federal Reserve moving forward is to hike or not to hike. And our best guess at this point, and we'll hold the ability to change our opinion, but we don't think that the Federal Reserve increases interest rates anymore. So we think this past rate increase last month was the last one. If there are any more, we think there's only one more. That's what most everyone is expecting at this point. A few reasons why we think that we might not see the Federal Reserve increase interest rates anymore. Everyone remembers the banking sector, kind of, I won't call it a crisis, but more of a hiccup crisis. Had a few banks collapse. The Federal Reserve had to step in. Banking standards has become much more tight because of that. And that's one of the goals when the Federal Reserve is increasing interest rates, is to have the banks lend less money. And then a number of the inflation reports that have come out over the past few weeks, inflation has come in lower than expected. So that is good news as it pertains to if the Federal Reserve will stop the increases moving forward. So
just one more thing there. Excuse me for interrupting. We do not think it's a systemic problem within the banking sector, but you had 3 banks that made some poor decisions, and because of those poor decisions, those banks got into trouble, and unfortunately affected the rest of the banks as well.
yeah, great point. Thank you. So like we said, we think we're nearing the end from the Federal Reserve tightening or increasing interest rates. If you look there on the right side of the slide, the little red star is the last hike last month. The green star is what is projected to be actually the first interest rate cut, which they're saying is somewhere late spring, early summer of next year. That's contingent on a lot of things, and quite frankly, no one knows for sure. But at some point, we do think we see these short-term interest rates move lower. We've gotten the question a lot. Well, Matt, Randy, cash is yielding over 5%. Why would I want to own bonds or CDs? And that's a great question. But the short-term rates, just as they quickly can move higher, Mr. Powell could come out and say, we're moving short-term rates lower. And in the following week, you would see the interest rate of the cash move lower. We like locking in some of those yields on what we call further out bonds, so maybe a 1 year, 2 year, 3 year bond, where we could be getting a little bit less interest, but if and when interest rates do move lower, you get to keep that rate of return until the bond would mature or in some cases get called away from you. So here's one of my favorite slides that we put together, a little bit busy, but I want to draw your attention to the right side, the 5 reasons interest rates we think could move lower. And I'll start with number 2. Like we've already discussed, we think the Fed's tightening cycle is coming to an end. We think inflation has peaked and will continue to move lower. Something interesting, up until June to have inflation move lower. So from June of 22 until June of 23, having inflation move lower, I'd say it was maybe lower hanging fruit. From a standpoint, you had such high inflation on the books, it was almost easy to move that number lower. Moving forward, we think it's going to be a little more difficult. It's going to take a little bit longer to get that inflation number, which the Federal Reserve says is around 3%, and they want it closer to 2%. It's going to take a little bit longer to kind of get the football across the goal line, but we do think that trend does continue. Tightening lending standards, banks are just not giving out free money like they have in the past, and investors as a whole are kind of waking up and saying, hey, bonds, CDs, maybe that is a good place to have some investment dollars for some time. So those we think are the tailwinds to having interest rates move lower. We don't necessarily think that happens in the next few weeks or maybe even the next few months, but we would say over the next year, we would expect interest rates to move lower. And I would say the so what, or what does that mean to you as a client, as a investor? What we did earlier this year for most all clients is we shifted some of our lower quality bonds to some higher quality bonds. So we think if that narrative holds true and interest rates do move lower, you want to be positioned in some higher quality bonds, which is we increase that for most all clients, like I said earlier this year. So higher quality bonds tend to do better if interest rates do move lower, and the yields, what they're paying the client, are a lot more interesting, I will say, than they were this time last year.
Okay, let's move on and talk about the economy. Obviously, you've lived through history. We've all lived through a period where the government basically pushed the stop button on the economy during COVID and then pushed start again. And you would think that the economy would take longer to actually recover. And obviously, it's been some hiccups along the way. But we think of the economy perhaps as a big jumbo jet there in the picture, and the jet has taken off, and so the economy continues to do well in spite of some stuff going on there. So we go to the next slide. The GDP is a measure of all the goods and services produced in the country, gross domestic product. And you can see there, third quarter 22, fourth quarter 22, first quarter 23, and second quarter 23. Remember, people keep talking about a recession. A recession is 2 straight quarter measurement periods where the economy shrinks. It could shrink 0.1%, it could shrink 1%, or it could shrink 10%. But these are the components of GDP measured on the right, and you'll see the consumer is still over 2/3 of that, and the consumer is still in the game, and as long as they still spend, things typically work fairly well. On the bad news side, looking at the federal government has not been a good steward of things. Look at the for the federal deficit and the net interest outlays. need we say that the government's debt is too much and it's growing too fast. And one of the big things going forward is, how do you dig out of this? How do you inflate your way out of it? How do you grow your way out of it? And again, a continuing concern. I wish we had the answer, but you know, you can see there on the bottom right-hand side, the net debt as a percentage of GDP has gone higher. But the good news is not as high as it has been. So anyway, there we go with regards to the federal finances. Health of consumer, household debt service ratio, debt payments as a percentage of disposable income. Consumer debt is higher, but it's not at levels where people are really worrying. One of the big banks just reported that their net charge-offs for credit cards remain somewhat steady. So, you know, you really worry when people lose their jobs and they have to default on their credit cards or default on their loans, companies defaulting, etc. So, but the consumer balance sheet, again, their house and you know, their pension funds, other financial assets, etc. But again, household debt service ratio is off its off its lows. So, but we're not really worried about many of those levels.
So it kind of continuing with our airplane theme, how will the economy land? I remember this time last year, there was a gentleman, he's not a client, he reached out and he was bet his life certain, very adamant that we were going into a deep, dark recession. And he was also very adamant on the timing of when that would happen. He said it was going to happen in the next few months. Once again, this conversation was about a year ago. And that, as we know, just hasn't been the case. So it's a little bit hard, to his credit, on timing when we will see a recession. We're quoted kind of at our first webinar of the year back in January as saying we thought it was going to be fall of this year, early next year. We'll see if that's true or not. But just to review, these are kind of some, I'd say, words you hear thrown around a lot, whether you have CNBC on or reading something online. Soft landing is what typically most everyone is pulling for. That would be some economic growth to land the airplane with no recession. A hard landing is when you typically have a recession. The Federal Reserve lowers the interest rates, but the economy does contract, like Randy mentioned, for more than 2 quarters in a row. So there's a lot of smart people on both sides that will argue both points. If you made us pick one, we are leaning towards thinking a soft landing is possible. Just from a standpoint, we'll look at some of the numbers, but right now, this would be a very peculiar recession with a lot of the numbers that we're seeing. But thought it was helpful just to review those two terms because they are thrown around a lot, and we do get the question probably once a week on, remind me what a soft landing versus hard landing is. So unemployment remains by historic standards really low, just above 3.5% as of July. Wage growth was faster from May to June. This is a big piece of the inflation narrative, that when there's wage pressure, typically there is inflation. We did have new jobs, but fewer new jobs, and really no change with the layoffs, the quits over the last few months. So bottom line is this: the economic data we think is mixed. The labor market continues to be resilient, which is kind of a good news, bad news, depending how you look at it. We love that more people are employed, but that is one of the main things the Federal Reserve has been watching to kind of be the governor to slow down the economy moving forward. So let's transition to the financial markets. 23 has been a good year for stock investors. For bond investors, it's been a lot less worse, I'd say, than last year. But let's first start with the stocks. We think there are a couple of reasons to remain optimistic about the long term. And as a caveat, let's kind of take a step back, and I'd already be retired if I had $1 for every time I told clients this. But Warren Buffett has a famous saying. He says, neither I nor you are smart enough to predict what will happen to the stock market within a year from now. And if Mr. Buffett is not smart enough, we don't think Randy nor myself are either. So when we look at the markets, we're looking more long term. We're saying, what do we think is going to happen over the next 1 to 2, 1 to 3, 1 to 4 years, not necessarily over the next couple of weeks. So with that kind of being our backdrop, we think when we look back at history, number one there, the macro factors, we think the Federal Reserve has had their last interest rate increase. When you look back at history, after that increase, stocks tend to do well. History doesn't repeat itself, but it often does rhyme. Margins have remained resilient so far this year. Third year of presidential cycle, which we are in, is typically a positive year. And companies as a whole have a ton of cash on the sidelines. So that is a good news for as it pertains to reinvestment if they feel like they do need to hire. And then the fifth one, whether it's companies, private equity firms, whatever it is, M&A, the merger and acquisitions, could be picking up here after a slow start to the year.
So interesting chart here, quote unquote, a bull market could have bulls smiling soon. The good news is once stocks are up 20% off the lows, then continued strength in the market is quite normal. Since 1956, the S&P 500 has been higher 12 times and in very impressive 17.7% on average 1 year after a 20% bounce. So the only time stocks were down was during the early 2000s, where we had the tech bubble bear market. Sort of a busy slide, but again, statistics look to be on our side at the present time. So if you remember and been following sort of what's happened in the stock market, there was a lot of uncertainty all year long, but certainly around the big rally in June. Early on, the majority of the gains for the market were driven by a handful of the big tech stocks, which had sort of gotten beat up last year. And that had people talking, some of the really smart, pointy-head experts. But the S&P 500 advanced decline line crossed at a new all-time high, which is a bullish signal that that there is a higher trend going forward. So anyway, again, trying to use statistics here to make decisions not based on feelings, not based on hope, but based on statistics. But the rally, the big news is the stock market rally has gotten wider after just beginning with just a few stocks.
And wider is good. So we want, if there's 500 stocks on the S&P 500, we'd rather all the stocks participate than just have 3, 4, 5 stocks really leading the charge, just because that is a real positive sign typically for markets moving forward.
Good point. And let's talk about earnings. First quarter earnings declined, but overall earnings were better than expected. And you can see some statistics there. 78% of the S&P 500 companies reported better than expected earnings for the first quarter. Obviously, we'll be getting second quarter data to share also. But think about what happens when you have inflation. Companies need to raise wages. When you have inflation, interest rates go up and the cost of borrowing goes up. Short-term borrowing, long-term borrowing has gone higher. When you have inflation, raw materials move higher. And that's, again, when you get into inflationary period, it gets more difficult. But again, what is a period where the economy grows or shrinks? And how much does that affect the various companies that are in a portfolio? Obviously, a stock is just an indication of what people are valuing as far as future earnings. So when people think the companies are going to make more money in the future, they're willing to pay more for that stock. So good news is earnings have beat expectations.
Here's another thing that is a little more, we call it a contrarian look at the markets. Warren Buffett has another famous saying. He says, when others are greedy, I get fearful. When others are fearful, I get greedy. And this is essentially what he's alluding to, is how many people as a whole are bullish or excited about the stock market, bearish, negative on the stock market, or neutral. And looking at the most recent reading, the end of June, the bulls have dramatically increased from the previous month, but still in line with, I'd say, the historic norms. So we're there. This isn't necessarily very indicative of the pendulum swinging really hard one way or the other. It feels like right now the investor sentiment is pretty just status quo, where just a few months ago, though, it was very negative. So a lot of people will say, once, and looking at this blue box here over on the left, once these figures get below 60, typically is a good sign of when stocks could be moving higher in the short term. You actually saw that from May up until the end of last month. But right now, these numbers don't really jump out of the page of being really encouraging of the market moving higher, nor necessarily the other side of that, where we think the market's going to move lower. It's pretty, right now, we think status quo. Here's I think a good reminder, partially for our Live Well plan, but partially just for diversification and having a balanced, diversified portfolio. A little bit of a busy page, but what I want to draw your attention to are let's call it the North Carolina Tar Heel blue, kind of the baby blue there. This represents the balanced portfolio if we were to rebalance annually on there. And what I want to draw your attention to is the balanced portfolio is never the winner, but it's never the loser either when we compare it to domestic stocks, which would be the S&P 500, international stocks, bonds, or cash. And so the old tortoise and the hare kind of is the story that I think of. And if we look here on the next slide, while the balanced portfolio was never the winner, the gold bar, or maybe the yellow mustard bar, is the rebalanced portfolio. You see over a long period of time, and this is dated from 1999 through the end of last year, the rebalanced portfolio actually is the winner compared to all of these other, the bond market, the stock market, the international stock market, and just cash in general. So slow and steady wins the race. You know, we talk a whole lot about, we want to hit singles, maybe the occasional double, but I'll bring our attention back to a childhood hero of mine, Craig Biggio, a lifetime Houston Astro. He didn't hit a ton of home runs. He just kept getting on base. And, you know, he was a scrappy guy. He seemed to have a lot of steals as well, but he hit a bunch of doubles, a bunch of singles, but he just kept getting on base. And we think there's a lot of parallels with investing in retirement. You don't necessarily need to hit home runs to be successful. Let's just keep hitting singles and maybe the occasional double. So transitioning here, recession expectations in the national debt. I'm going to talk about recession, and I'm going to leave the fun stuff, national debt, to Randy. No two recessions are alike, and this is a little bit of a busy page, but if we did have a recession upon us here in the next couple of weeks, couple of months, it would be unusual by historic standards. And some of the data to support that thesis would be there continues to be a lot of stimulus of what the government is spending as a percentage of the GDP. So long term, Randy's going to talk about, and I agree, we don't like that, but short term, that historically has been good for markets. We mentioned earlier, really large cash balance on a lot of corporate balance sheets with number 2 there. Tons of jobs still available. I drive from my house to the office, and I wouldn't be surprised if I counted them, probably half a dozen to a dozen different storefronts with the sign "Help Wanted" in the front. So the employers are still looking for employees, which is typically not the case on the eve of a recession. Record swing in inventories. You can see the increase there. That's typically not the case. And while the spending on goods has decreased, the service spending remains strong. So some tailwinds. That doesn't mean that we don't think a recession is not coming. Our base case for a recession would be a mild recession. And like I alluded to earlier, timing it is next to impossible. But if you made us pick, we think it's into this year, early next year, of when we could see a mild recession. But humans, we are all linear thinkers. And so when we hear recession, we gasp and we probably think back to a 2020 type of scenario, or maybe even a 2008, 2009 scenario, just because those were the last 2 textbook recessions. And we don't think at this time, our best guess is we don't think it's nearly as deep, dark, or restrictive as either of those. So we could see a slowdown in earnings. We could see a slowdown in just overall economic output. If that's the case, the market most likely would have a pullback. But we don't think it's a draconian 20, 30, 40% pullback that would necessitate a potential change in investment strategy. And the reason for that is just based off the idea we don't think it would be a deep recession if we do enter one here in the next, call it 6 to 9 months.
So now to talk about the really fun stuff. Thank you, Matt, for that. The national debt, there's too much. 78% is publicly held. 22% is intra-governmental debt, almost $7 trillion. Social Security is a piece of that. And that's as we've talked about, both of these are problems going forward, and that's going to be one of the things that's going to be constraining to the growth of the country, as well as the country that you leave to the next generation. I wish we had a better answer for that, but again, important thing, and we wanted to at least have a few slides on there. It's interesting to note as we move to the next slide that the government debt between 2022 declined in some countries, and this is from the Brookings Institute. Strong growth and high inflation played key roles in reducing that, and so those are both good medicines. If you say, how do we work our way out of this? Well, if you have strong growth, a lot of people think that the energy and the energy exports are a way for that, and then inflation. If you had to take your choice between inflation and deflation, you would take begrudgingly inflation, but you just want the hyperinflation that was made famous in Germany during the Second World War, or from Argentina, or some of the other countries that have been bad role models. So economic growth and the national debt, as we said, growth and inflation have helped reduce U.S. debt. on there. The left-hand chart shows the debt to GDP ratio jumped to 108% before the pandemic, to 120% at the end of 2022. The only good thing is it's fallen from 135%, and that's primarily because GDP is increased. And if we look at another slide there talking about the government and interest payments, you sort of take the example of the average mortgage debt, which as of September of a couple years ago was about $346,000. So you're a consumer, you have a $346,000 mortgage, and your household income, again, the average was $71,000. Your debt to income ratio would be about 500%. So this is not a perfect way to sort of measure the affordability, but the government's income is not a job, but it's tax receipts. So what really matters is the government, our government, Uncle Sam's ability to pay its debts, and that's based on interest rates, which make up a big piece of what it will cost, and also tax receipts. When the government was borrowing money at virtually zero, you would have thought they would have borrowed more long term, but of course that wasn't the case, and so again, the government will have higher bills to pay as interest rates go higher. Again, as we quoted, the 1-year Treasury earlier is over 5%. And the middle chart there shows the real problem, and that interest payments will go higher with the higher interest rates. If you do puzzles, there's a puzzle there on the right, just awaiting you to get started. But we think retirement planning can be a puzzle, making sure you put together the pieces in just the right way. You don't try to force the pieces together. You make sure they fit. We are big believers in you need more than just the investment guy, the stock guy, the bond guy, the investment guy. Benjamin Graham, who was a mentor to Warren Buffett, said the best way to measure your success in investing is not by whether you're beating the market. Unfortunately, people are drawn toward that through TV and social media, etc., but by whether you've put in place a financial plan and a behavioral discipline, both very important, that are likely to get where you want to go. And so we talk about holistic. The sum of the parts is greater than the whole. Anyway, retirement, investments, insurance, cash flow, estate planning, income tax planning, etc. And these all fit together with regards to this planning process. So you need a plan, and Matt's going to share with you what you will get and need as part of having that financial plan.
And for clients on the call, this will be a review, but we create what we call our family index number. What rate of return do you need to be, quote, successful? And our goal, unless you tell us otherwise, is we want you to take the least amount of investment risk necessary to meet those goals. So this is the conservative rate of return that we use within your Live Well plan. And the old adage, under promise, over perform. It's we want to do just that. We don't want to try to promise some type of pie in the sky type investment return, and we may or may not hit it. We want these rates of returns to be very obtainable over a market cycle. And so that's kind of one of the pieces of the Live Well plan. We call it a Live Well plan because Randy and I both were kind of cheesy and we couldn't come up with a better name. But deep down, we really do want clients to live well. And Randy sometimes poses as an old Baptist preacher and talks about the comfort, confidence, and clarity that this Live Well plan can afford you. But we do think it's true. We think this really is the cornerstone of planning for a successful retirement or walking through retirement. So with that being said, whether we're talking about it or not with clients, we're always updating this plan behind the scenes as it does help us make investment decisions for clients moving forward.
Yeah, that's well said, Matt. I mean, it's really a touching moment, an aha moment when clients, you can see it in their eyes. And for the first time, they have clarity, they have enough clarity that they can, do 1, 2, or 3 gifts to kids, grandkids, travel more, and they're not going to be a financial burden. So clarity does lead to confidence, and confidence leads to what everybody's looking for in that comfortable time at retirement. So speaking of time, we are very appreciative that you took time out of your day to join us again on a regular basis. We are in the education and also the communication business. Feel free to reach out with any questions or comments. Matt, do you have any questions that before we let everyone go?
We had one question: what's an example of a higher yielding or higher quality bond? And that would be investment grade. So there's 3 main rating agencies out there: the S&P, Fitch, and Moody's. And so they would say anything that's a triple B, a single A, a double A, or a triple A bond, that would be investment grade. Anything below that, you've probably heard categorized as a junk bond. So we think focusing more on the investment grade bonds is our thought here moving forward for the next few months.
And the ultimate investment grade bond, even with the downgrade, would be a CD or a treasury bond of that sort. So anyway, so that's the team: Maddie, Tiffany, Matt, and Melissa. And again, our contact information, phone number is there. We are adamant that everyone does need a wealth coach, and that is, we think, great advice for each and every one of us as we move forward. So again, thank you for your time. We are available if something with regard to your specific situation you didn't want to mention. And again, thanks for joining us. Hope to see you real soon on one of the Price Group's communication education events. Thank you. Have a great day.